it's very situational. Everything about real estate is what is your end goal and what kind of steps do you want to take to get there. And you have to make sure that the benefits of a HELOC outweigh those of a refinance or whatever your goal is down the road. They have to line up. Setting out your goals and discussing your goals and talking to a mortgage professional about how to move forward is definitely the best step to take before you consider either the refinance or the HELOC product.
What is up, YouTube? Matt McKeever here, and in today's video, we're going to be discussing HELOCs versus refinancing. This is a common subject matter. I probably get this DM at least once a day from someone asking me about whether they should get a HELOC or whether they should just straight up refinance their property. So I figured, why not bring in the experts and get their perspective? So Josh and Ehren from the Findlay Mortgage Team are going to sit down and break down for us today the differences between a HELOC and actually refinancing your property and the considerations that we should be taking into consideration as real estate investors trying to grow our portfolio. What is up, YouTube? Matt McKeever here, and we're back with another Findlay Friday Finance with Josh and Ehren. And today we're going to be talking about HELOCs versus refinances. And this is a subject matter I get way too many DMs about, so I'm really happy that we're shooting this video today, because from now on, this is going to be my answers, this video, guys. So let's just solve all the questions around HELOCs and refinances today.
Absolutely. Great.
Yeah, it's something that we get asked a lot too, and the main kind of subject topic is moving forward with another purchase, ideally a rental purchase, and it really comes down to, I think, what your goals are, and we'll talk about that kind of at the end after we outline all the differences. But goal setting and what kind of benefits you need. So we'll kind of start. One of the big differences is the loan to value that you're able to go and the maximum amount of use that you can get. With the HELOC, you're really maximized at 65% of the loan to value on that on the property. Whereas on a refinance, depending on what lender and what type of property it is, you have the ability to go to an 80% refinance and pull out all that equity and be able to use it. Now, with COVID, there is a little bit of a slight reduction in the amount of equity that borrowers have been able to take out. There are some lenders that have capped it at $75,000. But there are some lenders who still have it at up to the $200,000 and sometimes more. So it depends on what the application fits for that borrower. But the main difference right there is your 65 versus that 80% takeout.
It's a down payment. So as most of you know, there's some pretty large banks that just came out and said that you can now use a home equity line of credit to borrow for a down payment. That's new with, I guess, that bank, but there are a bunch of other banks out there that do allow you to use your line of credit. That being said, each one has kind of a different way in which they calculate the use of that line of credit and how it works. So for the home equity line of credit, the majority of these lenders are looking, some lenders will allow you to use 10%, and some lenders will allow you to use the entire thing. It really just depends on the type of lender you're looking to use. Some lenders will take a look at 1.5% of the outstanding balance on that line of credit. So basically, if you have a $10,000 line of credit that you've used for your down payment, 1.5% of that is going to be your monthly payment. Some lenders, on the other hand, will use a contract rate at maybe a 3-year contract rate, and they'll actually amortize it out over 25 years to make your payment lower to allow you to qualify. So there's a handful of different options available to somebody depending on obviously the financial situation and what the ratios look like. But lenders are opening it up now to be able to use your line of credit to be able for a down payment. That being said, really important to understand that it does go in your debt servicing ratios, and you need to be able to qualify for basically borrowing the money from yourself for the down payment as well as the actual mortgage itself.
Yeah, you got to qualify twice. You got to qualify on the or the refinance with the HELOC, and then if you still have that HELOC, obviously when you maximize it out or whatever you use for the next purchase, you got to qualify that again. So you almost got to qualify twice. And then down payment, all equity sources are capable to be used as a down payment with no limit. So it's not that a HELOC is the worst choice in that case. It just sometimes it can limit what type of lenders you're going to be able to work with moving forward. So if you want options, maybe a refinance with full equity takeout might be the best choice for you depending on your application. Next we want to talk about is just the rate. So the HELOCs are a variable rate based off the Bank of Canada prime rate. So you're looking at 2.45% right now. And then your actual contract rate is usually prime plus or minus a certain percentage. So right now with some of the COVID measures that they put out just to keep the lines of credit flowing freely, variable rates are pretty attractive right now. So that definitely has a little bit of benefit there. Whereas on the refinance side, you have all the options kind of available to you. You can go with the fixed rate, or you can go with the variable rate as well too. So do get a little bit more options on that side as well when you're considering the refinance over the home equity line of credit.
Yeah, one of the most important thing really is that your variable rate is still going to be cheaper than what your rate is going to be for your line of credit, but it's really just the utilization, how you want to use it. We're going to get into that a little bit later, but it has everything to do with how you want to use the actual product that you're getting. In regards to payment, home equity lines of credit are really interesting because all you have to do is make the minimum payment, the interest payment on the loan, whereas your actual payment for a refinance is just your regular mortgage payment. Now, obviously, your regular mortgage payment is most likely going to be lower, dollar value-wise, per month than what your minimum payment is going to be for your home equity line of credit, obviously depending on how much money you're looking to pull out. But if you're looking to just have a consistent monthly payment and not have to worry about a fluctuating payment, I would say home equity line of credit, a refinance is probably the most consistent way to pull equity out and use it for a down payment. But the home equity line of credit basically varies depending on how much you want to draw out.
And the next thing we want to touch on is just what that new amount does for your debt obligation. So whether you're pulling it out on the HELOC or whether you're pulling it out in an equity takeout. So on the HELOC side, I think Josh touched on this a little bit earlier, but there are some lenders who will use 1.5% of the outstanding balance. But there are some lenders who take a look at HELOCs a little bit differently, and some lines of credits as well, but we're not going to touch on that right now, where they might actually use 1.5% of the limit. Because you do have free access to that product at any time, some lenders may assume that there is a risk of it all being used. So they may actually qualify you off your limit and not always your balance. So that's something to talk to your mortgage agent about maybe, and make sure you're using the right lender depending on what your limit could be. And another thing that some lenders may do, and we see this a lot with credit unions sometimes, is if you're looking to purchase a property with them and it's your HELOC is with a different bank, they may want you to bring that line of credit and open it up with them so that they kind of have a control of your assets and seeing that fluctuations in your bank account. Or if it's over a certain amount, usually around $50,000 to $60,000, they may ask you to close that line of credit also. Just because, again, it's something that you have free access to and could increase your debt obligations and your monthly liabilities. Whereas with a refinance, you're really only left with your principal and interest payment as your debt obligation moving forward. So just your standard mortgage payment.
There's a lot less risk associated to a lender that they understand that you can no longer take on more monthly debt. Whereas, there are lenders out there, depending on obviously who it is, if your line of credit is large enough, say $50,000, for example, as Aaron said, they might have you close it because your ability to be able to draw on that, even if you can't, is a liability to them. And a lot of investors get a little upset about it just because they work so hard, obviously, to be able to get it and have the equity in it. They want to use it. The risk to the bank, unfortunately, is too large if you have a really big line of credit, which can be difficult for financing or moving forward, depending on the lender you're using.
Yeah, and just building upon that, guys, it's important to take into consideration like your entire business plan, right? So I know a lot of investors get caught off guard. They're like, I've got the line of credit, I'll do my rentals this way, I've got everything lined up. And then they get hit with that surprise, which is like, oh, hey, no, we're actually going to ask you guys to close out the line of credit. So this is where working with a mortgage professional that really understands your entire business model from start to finish is critical, because they'll help you navigate that and find the right lender.
Yeah, absolutely. And there's some, I want to say best use cases, but some, situations that tend to fare a little bit better if you have HELOC. So for flippers, a lot of flippers may tend to go with a private lender just for ease of access into property, depending on how dilapidated the property is or what the situation is with the property, if it's a gut job or something like that. The private lenders aren't going to look at the outside debt obligation. So if you have a HELOC that's loaded or using it as a down payment, they're not going to make you debt service that from your previous job, or like I said, from the current down payment that you're going to use. use. And they're not going to ask you to close it or transfer it over as well too. So that's, really a more beneficial situation, but it's kind of specific to those flippers. And on the BRRRR strategy as well too, there are some borrowers out there who are getting in on with a private lender and then fixing up and moving forward with the refinance, and that can be a good situation to maybe use your HELOC as a down payment, and then on the refinance, we can direct that equity takeout to pay off part of the HELOC and get you in within your qualifying ratio. So that's something that we can work on too.
It's really actually important. We're running into it a lot right now, is where if you have a line of credit that you've used for, say, renovations for a home, it's easier for a lender to be able to direct funds to pay off that line of credit than it is to be able to give you a large sum of money right now. Some are capping it at 75, some are capping it at 200,000. But depending on your project, if you buy a $650,000 home and you put $200,000 in it, it's hard for a bank to be able to give you $200,000 in cash if they can't show or direct it to what it is. And I know a $200,000 line of credit is a little bit ridiculous and not a whole lot of people have it, but it's easier for a bank to be able to direct funds to pay something off than it is to give you cash at the end of the day.
Yeah, or trying to dig through your records and finding unpaid quotes from contractors or something like that. Like they can do that, but again, like Josh said, it's easier just to direct it all to one line of credit than having it directed and separate into multiple different payments, for sure. And then the other thing that we want to touch on too is, if you're going to look at getting a HELOC, when would be the best time to do it? Within your first few properties is probably the best time to do it for a few reasons. One, a big six bank is probably going to offer you the best HELOC out there. There are some other great monoline products, like MCAP has a really great home equity line of credit product as well too, but typically speaking, the big six banks are probably who some investors are going to go to and home buyers for their first couple purchases. So having access to that off the start is good, but also as you start to grow your portfolio, being able to qualify for the HELOC is going to get a little bit more difficult, just because you're increasing your outside debt obligations from your other properties or further credit cards down the road, and just being able to, like I said, have an easier access to that on the qualifying within your first couple properties is going to be the easiest time to qualify for that product. Yeah, and then the last thing that we want to touch on with home equity lines of credits is it's very situational. Everything about real estate is, what is your end goal and what kind of steps do you want to take to get there? And you have to make sure that the benefits of a HELOC outweigh those of a refinance or whatever your goal is down the road. They have to line up. So if you're looking to, make a specific amount of purchases or purchases with specific banks, making sure that home equity line of credit is able to be used is going to be, key number one and factor number one for moving forward with your down payment. If that bank that you need to fit your debt ratios or use that rental offset doesn't accept a full down payment from the HELOC, it may not be the best option to use if you have equity sitting in a property. Maybe going with a refinance is a better option. So setting out your goals and discussing your goals and talking to a mortgage professional about how to move forward is definitely the best step to take before you consider either the refinance or the HELOC product.
Yeah, 100% agree. And I guess one last point on this subject matter I'd love to make is just understand that these rules and regulations are very fluid. So we're talking today in this moment, those are where the rules are. Like the guys touched upon already, in the past, it almost was impossible to use the proceeds from a HELOC as part of your down payment, where now we're starting to see that become, very commonplace. Again, those rules can change again. They could flip a switch, they can change their minds. So it's really important that you're constantly staying up to date and that you're contacting your mortgage professional so that they can keep you in the loop in regards to what's going on in this moment in time. I know everyone would love it if we could just give you a 10-year solution and you could just go implement that for the next 10 years. But trust me, over the next 10 years, the rules will likely change 20 times. And this is why we need someone on our power team that understands exactly what our business model is, as well as works with other investors like us, because they're going to be on the bleeding edge of understanding exactly where those rules and regulations are likely to land next time when we do have a shake-up or a change in rules. So just want to thank you guys again. I think they dropped some amazing knowledge bombs here, guys. So if you got value from the Findlay team, make sure you smash the like button. Hit the subscribe button if you're new to my channel, and we'll throw a link to all their contact information down below. But otherwise, jump in the comment section and let us know, what questions do you have for the Findlay team when it comes to financing your investment properties or anything to do with mortgages in general, because they're a wealth of knowledge and they're right here. All you need to do is comment in that comment section down below. Thanks, guys. Thanks again to Josh and Aaron for taking the time to shoot this video. If you guys got value from it, I'm imagining you did because you now better understand HELOCs and refinancing process. Smash that like button. Hit the subscribe button if you're new to my channel, because if you didn't know, less than 50% of the people that watch my YouTube videos are subscribed. I don't understand why you're throwing shade at me like that. I'm just saying I'd like you to correct it. Hit that subscribe button. It's actually free, so don't worry, you're not going to be charged a thing. If you guys have other questions for the Findlay Mortgage Team, let us know in that comment section. And a reminder, every Friday after I post a video with them, they're going live on their own YouTube channel where they're answering your questions live, just giving you the straight answers you need to get into real estate investing and stop yourself from getting caught up in that analysis paralysis.